Hey guys, welcome to my YouTube channel. So this is my first video outside of my introduction video that I put out a couple weeks ago. And so this video is called HGTV Lied to You. And why am I calling it that? Because there are so many buyers that come to us real estate agents and they have all of these unrealistic expectations of what the buying process is like. And it is nothing like what you see on TV. I am a victim of the HGTV marathons. I used to sit for hours and watch House Hunters and Property Brothers and think that everything was just super simple and you just walk into 3 houses and you pick one and then that's it. That is not the home buying process at all. It's so much more to it. Us real estate agents are here to help you along the way and to make it as stress-free as possible. But you have to balance the difference between reality and fiction. HGTV is trying to squeeze entertainment into 30 minutes. When in reality, some of these processes, depending on the situation, can take 6-7 months. And then I see buyers that are getting frustrated and they're feeling like, oh, I'm never going to get a house. It's going to happen. It's just not as quick and easy and as glamorous sometimes as it may seem on TV. So let's talk about the process so that you can understand the expectations that are going to be needed of you as a buyer when you are purchasing a home. Now, what do you need to do as a home buyer to get ready for this home buying process? First, make a decision. I want to buy a home. Okay. So one of the first things you can do is just do your research. Before you even reach out to a real estate agent or before you even speak to a lender, do some research online. Look at different resources. They have all types of mortgage calculators. There's resources on different types of loan options. There's all types of resources out there to help you predetermine, I think this is something that I'm ready for. The next thing that you want to do is look for a real estate agent, somebody like me, somebody that's going to help you throughout the process. Generally, somebody like me, a real estate agent, we're going to have different resources in place to help you along the way. One of the biggest resources that you're going to need throughout the process is your lender. Your lender is the person that's going to determine whether you can afford the loan or not on the loan or the mortgage. They're going to get you approved for the mortgage. They're going to look into all of your financial history, your financial statements and everything and determine whether you can even afford the loan or not. And so generally myself as a real estate agent, I'm going to direct you to a qualified loan officer who is going to help you on the financial side of that transaction. First of all, don't ever be shy to ask questions to your real estate agent. That's what we're here for. We are here to help you along the way. Some people get really nervous or hesitant to ask questions, or they feel like their questions are stupid, especially if you're a first-time home buyer. No question is stupid. Even if you're not a first-time home buyer, no question is stupid. There are a lot of nuances when it comes to the home buying process, and sometimes it's hard to navigate the process, and sometimes it's hard to understand. There's a lot that goes into it, and so you want to be informed, and you want to make sure that you are speaking to somebody qualified who can really give you all of the information that you require in order to help you make this process as seamless as possible. So, what is a real estate agent going to do? A real estate agent, our job is to basically be the facilitator of the transaction. So we are going to listen to your needs. We're going to have a buyer's consultation with you. We're going to speak with you. We're going to hear everything that you say are your wants, your needs, your desires as far as this home goes. Okay. Then we're going to send you to a lender. A lender is going to look at your credit score. They're going to look at your income. They're going to look at your debt to income ratio. They're going to look at all of your finances to determine, can you afford a loan? And then also, what kind of loan can you afford? There are different types of loans. There's the FHA loan, which is for the first-time home buyers. There are conventional loans, which is more of a general loan. It doesn't have as many stipulations attached to it. There's a VA loan if you are military or veteran. There's USDA loans if you're purchasing purchasing in like rural areas. There's different types of loans that you can acquire. The lender is going to be the person who is going to determine whether you can afford the home or not and determine which loan best suits you. That is not something as a real estate agent I can determine for you. But you want to make sure that you're setting yourself up for the best possible scenario. How can you do this? Making sure that you don't have a lot of debt. Making sure that you're lowering your debt as much as possible before trying to acquire this home. You're going to pay off things like credit cards as much as you can. Pay down your car as much as you can. You're not going to make big purchases on your credit. When you are trying to buy a home, that is going to hinder you in the process. Do not put major purchases on your credit when you are trying to purchase a home. It is going to affect you when you are trying to purchase a home. Lenders are going to be looking at your debt to income ratio. They're going to be looking at how much debt do you have in comparison to how much income that you make. And when you are putting large purchases on your credit, it is going to impact that ratio that they are looking at, which could impact the amount of money that you qualify for and the loan that if you even qualify at all. So things to keep in mind. Also, you're going to need a down payment depends on the type of loan. For FHA, you put down as low as 3.5%. For conventional loans, sometimes you can put down as low as 3%. Sometimes you have to put down 5%, but it varies. That's as low as you can put down. You can put down as much as you want to put down. And the more that you put down, the lower your monthly payment is going to be. So if you're able to save and you're able to put down up to 20%, or if you're able to put down 10%, great. Your mortgage is going to be lower on a monthly basis. The other thing that you're going to have to pay for is what we call closing costs. Closing costs are a variety of different fees. Attorney's fees, sometimes they're taxes, insurance. There's all types of fees that are included in your closing costs. Some buyers ask for sellers to contribute to their closing costs, but some buyers take on that cost on their own. Your closing costs, you can estimate to be about 3 to 5% of the purchase of the home. If you were talking about a home that is $250,000 and you get an FHA loan and are able to put down 3.5%, you were talking about $8,750 just for the down payment. Then you have to put down 3 to 5% for your closing costs. On average, your closing costs on a $250,000 house could potentially be $10,000 if you're talking about 4%. So $10,000 plus that $8,750 is $18,750. It is not going to be the same cost that it's going to take for you to get into an apartment or something like that. This is an investment. Think about it as putting money into an investment. That's what you're doing. You're investing. So it's going to take a little bit of money up front. I don't want you to get sticker shock when you see that number at the bottom of a settlement statement. I can get to that later. But you don't want to have sticker shock when you see that number at the bottom of your settlement statement. It's going to take you a little bit of money. And this is the thing that you're working towards. This is why you're working. This is why you're saving, because you want to be able to comfortably put that payment down on that house and get your home. The money aspect of it is one thing. It throws a lot of people off, especially first-time home buyers. Sometimes not even first-time home buyers. Some people are really just thrown off about how much it costs to actually get into a home. There are also things like you're going to have to pay for inspections. An inspector is going to go through the house once you actually, let's back up. So you come to your real estate agent. You speak to your real estate agent. We do a buyer's consultation with you. We speak to you about all the things that you wish to have in a home. Oh, I want 3 bedrooms. I want 2 bathrooms. I want an island. I want a backyard. All of the great things that you want in a home. Great. We jotting down our notes. We taking down our notes. All right, cool. We know what you want. All right. Then we're going to send you to a lender. Let's see if you can qualify for a home, right? The lender's going to say, you know what? You got this 750 credit score. You make X amount of dollars. I think that you qualify for let's say $300,000 house. And just for today, the market changes, the market fluctuates, but for today, your interest rate will be 3.1%. Cool. That lender is going to send a letter back to me saying that you are pre-approved for $300,000 at a 3.1% interest rate. Great. Let's go start looking at houses. Now, again, you told me you want 3 bedrooms, 2 bathrooms, you want an island, you want a backyard, etc. Cool. You told me what area you want to be in. Cool. So we start looking at houses, and we go out and we start looking at houses. You walk through, you walk through, you walk through. You tell me, Danielle, I like this one. Okay, let's put in an offer. The house, first of all, just because the lender approves you for $300,000 does not mean you need to max out your approval. $300,000 is what they're saying maximum you should be spending. So if you want to be comfortable, you might want to look a little bit below that. You might not want to max it out. You might want to look at 250, 260. You tell me, Danny, I like this house. All right, let's put in an offer. An offer is what we are presenting to the seller to say, this is how much I'm willing to pay for this house. I love this house. This is how much I'm willing to pay for it. Now, there's a couple of things that are included in the offer. There's your sales price. There's a due diligence period. Due diligence is the period where you can do an inspection. That's when you're going to call an inspector. That's something else that you have to pay for. You're going to call in an inspector and have them check the whole house to make sure it's not crumbling, to make sure the roof is not caving in, to make sure there's not mold growing around the house. You're going to call the inspector during that due diligence period to make sure that the house that you're trying to buy is going to be safe for you, for your family. You're going to make sure that it's a good purchase for you. Some people forgo the inspection. I personally don't recommend foregoing an inspection. You don't know what you're getting into. Like everything, people can slap some paint on the walls, but that does not mean that it's a good purchase. You need to make sure that the house that you're buying is solid. That's the due diligence period. The due diligence period can last a few days. Some people do it for extended periods of time, but generally it's just a few days. You have an inspector come in. You also have the right, you also can pull out, you can change your mind during that period of time and say, I'm not feeling that house anymore. You can pull out during that period with no penalty. Also in your offer is included earnest money. What is earnest money? It's a deposit. It's basically telling the seller, I'm serious about this house. I'm putting down a deposit, putting down a cash deposit on this house. That earnest money is at the end of when you're closing on your house, is going to be applied to your down payment or your closing costs. But you're putting the money up. You're going to put the money up front. And you could potentially risk that money if you, say for instance, you're out of your due diligence period. Say your due diligence period is 3 days. You get an inspection done. Nothing's wrong with the house. But you have a due diligence period of 3 days. On the 4th day, you decide, I want to pull out of this house. Guess what? You are giving up your earnest money. That deposit, that good faith deposit, that deposit saying that I'm serious about this purchase, you are giving it up when you pull out of that deal outside of that due diligence period. The due diligence period is there to protect you. There are a few different contingencies that are built into the contracts in order to protect you. So there's the due diligence period, there's your financing contingency, and there's your appraisal period. So your appraisal contingency. So your financing contingency is going to say, hey, you have X amount of days to have your financing approved. You have your financing contingency. Say for whatever reason, during that period, your lender says, you can't qualify for this. You don't qualify for this. Or we can't make the numbers work, or we can't get you, we thought we could do conventional. We're trying to do FHA. We're not really seeing the numbers work. The financial contingency is for the lender to approve, is for the lender to say, we're good to go with the financing and we can move forward with the transaction. The financing part is good. So that is another contingency that's built in. If the financing falls through for whatever reason, you can still potentially get your earnest money back if you're still within that contingency period. The other contingency is an appraisal contingency. Generally, unless you're paying cash, the lenders are going to require an appraisal because they're not going to give you a loan for more than what the house is worth. So they're going to have an appraiser go out there to determine the value of the home. All the contingencies that you built into your offer are starting on day one that you go binding. Binding means that both the buyer and the seller have both signed off on the offer, agreeing. It's a binding contract. Both buyer and seller are agreeing on this offer. So when you first go under contract and all of everything that's written to the offer, once everything goes binding, once both parties sign, that means that all contingencies are going to start on day one. So say, for instance, just giving an example, you have a due diligence period of 5 days, right? That means from day one, once everybody signs, you have 5 days to get your inspection done. Sometimes there's negotiations that happen because maybe the inspection comes back that the roof is caving in, and you have to determine whether you want to have the seller fix the roof. If you want to get credits to fix the roof, you are determining whether something's wrong with the foundation. You can have different contractors and things come in to look at the home to see how much it's going to cost, and then you try to negotiate costs and things like that during the due diligence period. All of that happens during that period. Then say you have your financing contingency. That also starts on day one. But financing contingency, say you have 15-day financing contingency. That means you have 15 days from the date that you go binding to secure your financing on this home. That's going to be dealt with through your lender. Then you're also going to have your appraisal contingency. Appraisal is going to be required from your financiers, from your lenders. And an appraiser is going to go out and say, like I said, you offered $250,000 on this house. The appraiser might say, we think the house is worth $245,000, not $250,000. So you're $5,000 off. In the case that the appraisal comes in low, you might have to negotiate with the seller like, hey, the appraisal came in low. Are you willing to knock down $5,000? The appraiser said the house is only worth $245,000. They might agree, they might not. Some people are bringing what's called an appraisal gap to the table, which basically means they're bringing cash to the table to fill in the gap. So say you offer $250,000 and the appraisal comes in at $245,000, and you have written into your offer that you would pay an appraisal gap of $5,000. That means that you would be willing to bring cash to the table on top of your down payment and your closing costs. You're going to bring an additional $5,000 to the table to fill in that gap. So to get the seller to $250,000. So if the appraisal comes at $245,000 and you offer $250,000, and you wrote into your offer that you would give a $5,000 appraisal gap, that means that you would bring $5,000 in cash to get them up to that $250,000. Does that make sense? I hope it does. So all of these things are going to be happening. All these contingencies are going to be happening. There's also going to be, your lender is going to be in communication with you a lot. There's going to be a lot of documentation that is going to be required of you. And I want you to be ready for that because it happens pretty quickly. A lot of these transactions are happening in 30 days, let's say roughly 30 days, 25 to 30 days, right? And so a lender, they are gathering all of your financial information, anything financial, anything that's in your financial background, the lenders are going to be looking for, and they're going to be reaching out to you to get all of these documents uploaded because they have to send the documents through what's called underwriting. Now, the underwriters are going to be looking very detailed about all of your finances to see, can this person really afford this loan? See, like when they are letting you borrow money, they are taking on risk, and they want to make sure that you are able to afford this home. So they are going through very detailed with a fine-tooth comb to make sure that you can afford this house. it might seem very overwhelming, and you might say, like, why are they asking for all of these things? They might ask you for what's called like letters of explanation. So you might have to write like why you have a gap in your employment. They might ask you to send financial statements. They might ask you to hand sign, so you might need a printer available. There's a lot of different things that they might require of you, and you just need to be ready to respond very quickly, because the longer that you take, the longer it can hold up the process, and the longer it can take for you to be able to get into the house. It could extend the closing. It could delay the processing of the entire loan, and it could make it that much longer for you to get into your dream house. So whenever the lender is requesting things, everything needs to happen in a timely fashion. Time is of the essence is one of the things that is an obligation of not only the real estate agents, but also of the buyer and seller. When documents are required of you, you need to get them over quick, fast, and in a hurry, so that things can continue moving throughout the process. There's a lot of people working on this transaction, a lot. It's not just you and your real estate agent. Your real estate agent is really a liaison between multiple parties. So not just you, but they're talking to the listing agent. They're talking to the attorneys. There's a lot of people in the attorney's office that are working on this deal. There's a lot of people within the lending office. There are probably 10 plus people, if not more, working on your deal. And you might not ever speak to all of the people that are working on your deal. But there are a lot of people working behind the scenes. And so when you decide that you're not going to turn in documentation, it holds up everybody, not just one person. It holds up a lot of people. And people are not just asking you things for their health or because they think it's fun. They're asking you because it is a requirement in order for you to qualify for this loan and for you to be able to close. This is like big legal stuff, you know? Like some people are so cavalier about the whole thing, but this is major. You're exchanging property and ownership and real estate. It's a lot of legality involved with it, talking to the city, talking to making sure that the tax records are correct, making sure that the deeds are correct, making sure that there's no liens against the property. There's a lot of things happening that you might not be aware of when you're going through the process. So you can play your part by making sure that if documentation is asked of you, that you are turning it in. We greatly appreciate it, and that you're very responsive. One of the things that's very important is that if your real estate agent or the lender is reaching out to you, that you are very responsive, so that we can get responses back to the parties that have reached out to us, so that we can also keep the process moving along. This is serious business. I know some people are like, oh, this is not as fun as I thought it would be. It looks so fun on HGTV. It looks like a blast, but it can be stressful. It can be tiring. It can be exhausting. You can be putting in an offer on a home where there's 30 other offers. And so you're competing, so you're going into bidding wars. The other thing that you have to understand is most people say, well, these houses are too expensive. I'm just going to wait. The prices are generally going to go up. That's just the fact of the matter. You can continue to wait, but the prices are going to continue to go up. So the longer that you wait, the longer you're out of the game, and the more expensive the more money you're going to have to put out down the road, because the houses are going to continue to rise and they're going to continue to get more expensive. So I would encourage you that if you feel ready, not to wait and not to be intimidated by the market and not to be intimidated by the fact that there's like bidding wars and things of that nature, or, you know, just making sure that you're keeping your eye on the market. And if you see something, jumping on it, because things are not going to get cheaper. So the longer that you wait, the longer that you sit on it, the more you might end up disappointed by what you see later down the line. The other thing is, don't go into, people want to haggle and get a deal. And this is not buying a car. You're not haggling and you're not like going back and forth. That's the other thing. When you see HGTV and they're talking about, and they're like, not just HGTV, but like even on a $1 million list in New York, and they're just like on the phone going back and forth, back and forth, back and forth with negotiations. No, everything has to be in writing. Everything, every time we go back and forth with another agent, we're putting it in writing and making sure that it's getting signed off. Like sometimes, like it's not official unless it's on paper. Another thing to note is that sometimes, like especially in this current market, there's not a lot of time to think. You don't have the time like, oh, we're going to go home and think about it. Sometimes the house might be gone. Some of these houses are being snatched up in 24 hours. Sometimes they're being snatched up in 3 days. And you done sat at home for a week trying to think about it and the house is gone. And then you're shocked that it's gone. These things are moving. You have to be quick. You have to make a decision. You have to be very firm in your decision. There's no time to be fickle. None. You don't really, with most of these houses, you don't have the time to like sit and think. Unfortunately, you might get a couple hours, but you're not going to get days and weeks to sit and think about it. You need to come into this process ready, like ready. I'm going to quickly go through the process from start to finish. You come to your real estate agent. The real estate agent most likely going to send you to a lender if you haven't already gotten pre-approved through a lender. The lender is going to say, boom, you're approved for this much. They're going to say, hey, you're approved for $300,000. Cool. They're going to send a letter back to the real estate agent. The real estate agent can then start your search because they know like, hey, they can afford up to $300,000. Cool. We're going to look at different homes. You're going to select the home. On the home that you like, we're going to put in an offer. The offer is your notification to the seller that you are interested in purchasing their property and for how much. In that offer, you're going to include earnest money, which is a deposit. You're going to have a due diligence period, which is going to your period to pull out, to do an inspection, to have contractors come in and look at the property. All of that can happen during the due diligence period. Negotiations can happen during that period as well if the price should need to be changed or credit should need to be given to you. Finance. Then you have your finance contingency. That's making sure that you can secure your financing. Then you have your appraisal contingency. That's making sure that the house is valued. The appraiser values the house at which you offered. And then once all of that's complete, you get to closing. Before closing, you're going to get a settlement statement. It's going to tell you what you owe and things that you have credits on. So like say you've already paid your earnest money, there's going to be a credit because that's going to be applied to your total of what you owe. You get your settlement statement. The lender and the attorney are going to look at all of the different things that are owed between both you and the seller, and then they're going to determine if we're clear to close. Clear to close is saying, boom, financing is good. Boom, they have the money to close. Everything's good. We're good to go. We're good to close. Then we get to the closing table. That's the exciting part. You're going to go to an attorney's office. Generally, sometimes you can do virtual, but you can go to an attorney's office and you're going to sign off. You're going to sign. They're going to give you a big stack of documents and you're just going to sign. As a buyer, you're just going to sign. Sign. The attorney is going to explain all of these things to you. And then at the end, you take cute pictures and you're a homeowner. It can take a little while. I'm not going to lie to you. Sometimes it can take a little bit longer. Sometimes it can be tiring. Sometimes it can be exhausting. It's a large purchase. So it's natural to get like anxieties about the whole thing. Make sure that you're being honest with your real estate agent about your feelings. If you're interested in pulling out, if you're getting cold feet, if you just don't feel like the property is right for you, make sure that you're being honest with your real estate agent so that they can help you make informed decisions about how to move forward on the purchase of your home. I want you to realize that it's not cheap. And I feel like a lot of people are coming into it and they're looking for a deal. They're looking to say, I'm gonna get a deal. I don't pay full price for nothing. And sometimes you can get things for under asking price. A lot of things right now are not going for under asking price. And if you think that you're going to compete against other offers, if you think you're going to compete against 30 other offers and you're going to be under asking and asking for closing costs. No. Stop thinking you're going to get a deal. It does happen sometimes, but it's like so frustrating when people just think like, I'm not paying this for that. Well, if you don't pay it, somebody else will. So if you love it, then you might as well put a strong offer in on, because if you don't, someone else will. And people don't care. This is people don't care about your feelings about, oh, I'm not paying that. Okay, well, you don't have to. Somebody else will. You're gonna lose it. And stop playing with people's time. Like real estate agents, this is our job. And a lot of times we're doing a lot of this without, especially when we're working with buyers, we don't get paid until we get to the closing table. So when we're helping you and stuff, we're not getting paid throughout this whole thing until you get to the closing table. So do not act like people are just trying to get money out of you or something like that. Listen, we worked hard for these licenses. We are not trying to get our license revoked on behalf of you. I'm not going to lie to you. We don't want our license taken away for doing unethical stuff. We work too hard for these licenses. There are many programs that can help you with your purchase, but there's not always going to be a program that you qualify for. And I need you to be prepared for just in case you might not qualify for a program. You might not. Like some people think like, aren't there down payment assistance programs, or aren't there this and aren't there that? There are. Those are things that your lender can speak to you about. But you might possibly not be qualified for the programs, which means that you would still have to come out of pocket for the full 3% for the down payment, or 3.5% for the down payment, or 3 to 5% for the closing costs. And you need to be financially prepared for that and not betting on the fact that you might qualify for a program, because it might not happen. And that's just the reality of it, unfortunately. Sometimes lenders can help you out. Sometimes there are different programs that you can qualify for. Sometimes banks have different programs. There are some different grants and things like that could potentially help you, but you might not always qualify. And I just want you to mentally be prepared for that. One of the last things I want to talk about, when we're talking about your monthly payment is what we call PITI, P-I-T-I. Your principal, which is the loan itself. If you're purchasing this $250,000 house and you finance 96.5% of it, because you put down 3.5% for FHA, right? So you're going to get a loan for 96.5% of that $250,000, right? On a $250,000 house, if you get a loan for 96.5% of that, then you will get a loan for $241,250, right? And so that is your principal amount. That's the P of PITI. Your I is going to be interest. So again, remember I talked about credit score. So whatever your credit score is, you will get a certain interest rate. And the interest rate varies, it fluctuates depending on the market, depending on your credit score. There's a few different factors, but your interest rate, and that's basically how much the bank is charging you to borrow their money. It's the same as a credit card or whatever, interest rate. So principal, interest rate, your taxes. So there's going to be property taxes that you're going to have to pay on a monthly basis. That money usually goes into what's called escrow. So escrow is basically like a savings account for the lender holding your money to the side, so that when your tax bill comes every year, you've already paid into that. You've already been paying on it on a monthly basis, and then they could just take that chunk of money and pay off your tax bill every year. And then there is insurance. So you're going to have homeowners insurance. You're going to get your home covered. So, and depending on the type of home you are in or the zones you're in, there's like flood insurance and things like that. The other thing is when you are putting down under like 20%, there are mortgage insurance. There's mortgage insurance for both FHA and conventional loans. And so that's an additional percentage that's going to be tacked onto your monthly payment, is that mortgage insurance. So when you're talking about your monthly payment, you're talking about your principal, your interest, your taxes, your insurance, and potentially your mortgage insurance, depending on how much you put down. It was great talking to you guys. I hope that I've been able to explain this home buying process to you in a way that is enjoyable and in a way that is easy to understand. And make sure you hit that like and subscribe button. And I look forward to continuing to talk to you all about real estate. Bye.